Let's now move away a little bit from static financial analysis, that is ratio analysis, and turn our attention to another problem, which is the problem of long-term financial planning. So the idea is, how does the firm plan its future growth and make sure that it has enough financing in order to satisfy that growth? So let me first give you sort of a big picture example so that you better understand where the problem is. So suppose that you have a typical company that has certain assets, certain liabilities, and equity. Okay, so imagine that the firm plans to grow and the growth rate is substantial. So sales are expected to rise. Now, why do we start with sales? Because sales are driving forces. Okay, all the companies grow because they expect sales to grow. Sales represent the overall volume of business. So if you expect sales to increase, if you are Tesla and you expect to expand in Chinese market, okay, you want to sell your electric vehicles over there, that would be your sales growth. So you have a sales growth forecast. So what happens is, when your sales are expected to rise, usually your assets are expected to increase as well. And that makes sense. In order for me to build new cars in high volumes, I might need new capacity. So I need to build a new plant. I need to equip that plant. I need more inventories. I will probably end up with having more accounts receivable because I will sell more on credit. And I also need more cash holdings because those cash holdings are needed for transaction purposes. So the point is, usually when sales are increasing, especially at faster rates, the assets are going up. So that would be your so-called asset requirement. But look at the balance sheet. If your assets go up, it's pretty obvious that something has to happen on the right-hand side of the balance sheet. There must be a corresponding increase in liabilities or equity. Aside from just accounting identity, it's pretty obvious that assets have to be equal to liabilities plus equity. So yes, increase in assets should be complemented by corresponding increase in liabilities and equity. But beside that, let's think about it logically. If I need to expand my capacity, if I need to invest more in assets, I need financing. I need to find resources to do it. No matter how optimistic I am about my sales growth, it is just a plan. That plan will never come to truth if I don't raise funding. Okay? So, if my assets are expected to grow, I need to figure out how am I going to finance those assets. And the first usual option is to use your retained earnings. So most companies are trying to use as much retained earnings as possible. So what's going to happen? Your equity will increase due to retained earnings. Okay, you got to be careful here. We are not talking about issuing new shares. That's a completely different story. Most companies prefer not to issue equity unless it's gigantic expansion. So normally we want to raise equity through retained earnings, and that makes sense. If I expect to grow my sales, my income will rise. I will take that income and I'm going to reinvest in the company to try to fuel that growth. But in most cases, retained earnings will not be enough, especially if you're talking about a relatively high growth rate. If the growth rate is relatively small and the company's income is already very high, example would be at Apple, okay? So if you look at Apple, they don't need to borrow because any relatively modest growth in their sales and as a result growth in their assets is easily financed through income that they generate. So they don't need to worry about any additional external borrowed sources of funds. However, if you're a younger company or you're a company that plans to grow very ambitiously, retained earnings might not be enough. So what's going to happen? You will calculate your delta assets. So that would be your projected increase in assets. And then you will subtract your delta retained earnings. So those are going to be your projected change in retained earnings. Okay, so sometimes we would stop right there. We would just simply say, okay, by how much my assets will rise, by how much my retained earnings will rise, and the difference would be my additional funding. But in some models, you would also add delta automatic liabilities. So automatic liabilities are liabilities that you can pretty much rely on automatically. A good example of an automatic liability would be accounts payable. So example of automatic liability, accounts payable. So why would accounts payable be considered automatic liabilities? Well, think about it this way. Accounts payable are the borrowings that you get from your supplier. So if you use some raw materials, you just basically borrow raw materials, you get them, and then you pay for them later on. So it's just an extended plan of payment. So why accounts payable might be automatic? Well, because the supplier is genuinely interested in your success. You are in the same supply chain, okay? So the success of your supplier will depend on your success. So normally companies have very good relationships with their suppliers. So if they show to the supplier that they are going to grow, that they simply need to finance their future growth in sales, supplier will gladly provide higher amount of accounts payable. So they will be willing to provide the raw materials, for example, to the company without demanding immediate payment. Now, you could make another assumption and say that my firm is relatively small. I don't have any influence on my supplier. Let's say you're a tiny semiconductor company on Long Island, and your supplier is the producer of plastic that sells billions and billions of tons of that plastic a year. I don't think you have any negotiating power. I don't think that supplier will genuinely be interested in your growth. You're too small. So if that's the case, then accounts payable would not be considered automatic liabilities because, again, you cannot count on your supplier giving you credit automatically. So it all depends on your assumptions. But for now, let's assume that you do have automatic liabilities in the form of accounts payable. So what's going to happen? You're going to project your potential change in assets, your automatic financing through retained earnings, and automatic liabilities. If that number is positive, meaning that increase in assets is bigger than retained earnings and automatic liabilities, you get something that's called EFN, external financing need. So EFN greater than 0 means that you need additional external financing. Okay, now what could be that external financing? Well, most likely it's going to be some long-term debt. It could also be relatively short-term debt, but it's something that you need to negotiate. You cannot get it automatically, so you shouldn't wait until you actually run into that liquidity problem. So you should not wait until you actually have that EFN. You want to project it. That's why this type of analysis is going to always be done on the basis of expected growth rate, expected change in assets, expected change in retained earnings, and expected change in automatic liabilities, and therefore expected external financing need. So let's say you determine that your expected EFN is equal to $1 billion. What you're going to do? You will start the process of negotiating financing. You will probably go to the bank, ask for a loan, or you will orchestrate a deal where you would issue some long-term debt. For example, some publicly traded bonds with 10, 20 years to maturity. Or if you want a shorter term loan, you could get into a commercial paper market and issue some commercial paper. Whatever you do, you need a plan. Because if you frantically start trying to raise money when you need it immediately, you will have very hard time. First of all, you may not be able to get money in the first place. The markets may simply shut down and not give it to you. Or alternatively, you might be able to get the resources, but those resources will be extremely expensive. You will end up paying premium because you need money on a short notice. That's why the financial planning that we're going to talk about right now is all centered about forecasting that EFN. Trying to figure out how to get these ingredients, delta assets, delta retained earnings, and delta automatic liabilities. Once we know how to do that, we will be able to forecast EFN, and we will be able to understand our prospects in terms of financing. And you know what? Sometimes EFN could be so large that the company might decide that their projected sales growth is not feasible. The market seems like the market is willing to accommodate that huge growth, but the company simply does not have financing. So the company is financially constrained. And that happens sometimes, and as a result, companies decide to grow a little bit slower. Okay? It's a shame. Everybody wants to grow as fast as possible, but again, markets are not 100% efficient. And sometimes firms that have good market, that have good demand and good investment opportunities may not be fully financed by the market, especially if you're talking about poor market conditions, the conditions of liquidity crunch. Anyway, regardless of market conditions, the first step that we need is to figure out how to calculate that EFN more precisely. So as long as you understand this big picture here, that's already a big step. The rest of it is just details. So, okay, so what are the main features of long-term financial planning? Well, first of all, you need to figure out your investment in new assets. So that would be your delta assets. You need to know your degree of financial leverage. You will see later why it is important. Because, again, if I go back here, because how much debt you're willing to undertake, right? If your EFN is positive, most likely you will increase debt. But by how much? How much increase in debt you're going to tolerate? And that will depend on your preference towards financial leverage. Okay, so we'll talk about that. Also, you need to understand your dividend policy. Okay, so again, coming back to this big picture, you will see that your addition to retained earnings will depend on dividend policy. Okay, so you will see in a moment, you will see why. We will derive exactly what change in retained earnings is going to be, but it will depend on dividend policy, and it makes sense. If all of my earnings I pay out as dividends, I will have no retention. I will have no retained earnings whatsoever. On the other hand, if I don't pay dividends at all, that means that I'm maximizing my capacity to add to retained earnings. So whether you decide to pay dividends or not, and in what proportion relative to your income, will determine how much of your financing will be coming from retained earnings. Okay? And then finally, your liquidity requirements will pretty much determine your decision to finance with long-term debt versus short-term debt. Okay, so your decision to put, let's say, X percentage of your external funding coming from short-term debt versus long-term debt will be determined by your liquidity preferences. Okay. All right, so what are the ingredients of financial planning? So how do we start? What do we do? Well, as I mentioned before, we always start with sales forecast. And luckily for us, we don't have to do it because we are not marketing people, we are in finance. So normally we work with what marketing people give us. Now, they may be wrong, and if marketing is wrong, then the whole financial analysis is useless, because if you grossly overestimate your sales growth or grossly underestimate your sales growth, then all of your projections will be wrong. But again, there is nothing we can do about it. We are not in the business of forecasting sales. Let's assume that marketing people are doing a good job. So you work with their forecast and you trust it. So on the basis of your sales forecast, you will create so-called pro forma financial statement. So pro forma means projected. Okay? So you will create your projected income statement, projected balance sheet, and then you will see if there is any mismatch between your projected assets, projected liabilities, and projected equity. So basically what you're doing, you're just creating balance sheet, assets, liabilities, and equity. And then you see by how much your assets will rise, by how much your equity will rise, by how much your liabilities will rise automatically, and as a result, if there is any mismatch. And if there is a mismatch, it will be your EFN. Okay, but first you need to create those pro forma statement. So while creating your pro forma statement, as I said, you will do your asset requirements. It's right here, your increase in assets, that would be your asset requirement. Then you will figure out your financing requirements. Okay, that would be what you can cover through equity and liabilities. And finally, you will figure out your plug variable. So plug variable is, think about it this way. You have a hole and you need to plug that hole. Same as here, you have increase in assets, you have increase in your automatic sources of funds, like in automatic liabilities and equity. If that is not enough, you have EFN. EFN is your hole. You need to plug that hole. You need to put something in it to close that gap, to close the deficit. That's what plug variable is. So it is determined by management decisions about what type of financing will be used. It's basically the variable that makes balance sheet balanced. Okay? So for example, let's say you determine that EFN, external financing required, is equal to $1 billion. Your plug variable could be $1 billion of long-term debt, or it could be $1 billion of short-term debt, or it could be $500 million of short-term, $500 million of long-term, and so on. So in this class, in this course, we will not worry so much about how to cover that deficit. Our job would be just to figure it out. Okay, just to figure out the amount of EFN. In terms of long-term versus short-term debt, that's a little bit more advanced, because that would also be related to your capital structure policy, your preferences towards liquidity, the cost of debt in the market, and so on and so forth. Okay? And finally, another ingredient of financial planning is just overall economic assumptions. So these are just overall economic conditions. For instance, the availability of credit, short-term versus long-term, the overall interest rates in the economy, the potential growth in gross domestic product. You need to be aware of what's going on in the economy to better forecast your sales and better be able to figure out how to cover your financing needs. Okay? So what we are going to do in this course, we will use a very simple approach. It's called percent of sales approach. So with percent of sales approach, all you need to know is your delta sales. Once you know your projected sales or change in sales, you will tie everything to your sales. So the idea of percent of sales approach is that once I know what my sales are going to be, I will make an assumption that most of the items on income statement and balance sheet maintain fixed proportions relative to those sales. As a result, once I know my current and future sales, I will be able to create those pro forma statements. Okay? Now, how reasonable is that assumption? Well, let's start with income statement for a moment. So, income statement looks something like this: sales, cost of goods sold, admin expenses, depreciation, interest, taxes, and then you have net income. Okay, so to be honest with you, if you really want to be absolutely realistic, you cannot assume that all of these items are directly related to sales. Luckily, one of the biggest items on your income statement, cost of goods sold, can be reasonably approximated as a fixed percentage of sales. So the idea is very simple. If my sales increase by 10%, I should expect my cost of goods sold to increase by 10% as well. Why? Because we assume that company is large enough, it already operates at constant returns to scale. That's what most companies do when they achieve certain size, when they achieve their efficiency level. For them to increase their sales by 5-10%, it will take 5 or 10% increase in cost of goods sold. So they're not going to economize anything on higher sales, so they won't be able to enjoy increase in returns to scale or economies of scale. On the other hand, they're not going to suffer any cost overruns. So most companies are operating in that constant returns to scale area. Administrative expense could be reasonably approximated by assumption that they also grow with sales. And that makes sense. If you increase your sales, you need more employees, you need to pay more for your utilities, you need to pay more for advertising, so most likely it will be related to sales. Now, one of the biggest suspects is depreciation. Depreciation expense will not depend on your sales, unfortunately, because depreciation expense is driven primarily by very specific accounting schedules. And those schedules are determined by what type of asset you have. So for certain assets, depreciation is even. Let's say 20% in year 1, 20% in year 2, 20% in year 3, and so on all the way to year 5. For other assets, it could be jumping all over. It could be 20% this year, 35% next year, 15% year after, and so on. So there is a lot of randomness in depreciation expense. It will depend on what type of asset you have, and it's determined by the accountants. So to say that depreciation directly varies with sales would not be a correct assumption. However, for now, we will assume that it is the case. We only do it for simplicity, because most of the time depreciation is not a very significant part of your income statement. So even though we make some error there, some measurement error, it shouldn't be very problematic. But again, keep in mind that if you really want to do it right, you should calculate depreciation separately. So what you would need to do, you would need to forecast your depreciation on the basis of depreciation schedule that you would know in advance given your assets, your fixed assets, okay? The same applies to interest expense. Interest expense is not directly related to sales because it's fixed payment that you make. It is more related to amount of debt and the composition of debt. So if most of my debt is fixed long-term borrowing from the bond market that requires $1 million fixed coupon payment every year, it has nothing to do with my sales. If my sales go up, there is no guarantee that my interest expense will go up by that same percentage. Chances are that the new debt I will issue will be more expensive or less expensive, or maybe I will not issue that debt at all. So again, assuming that interest expense is directly proportional to your sales is incorrect, but we will make that assumption for simplicity. You could think of a case where there is no interest whatsoever. So you could imagine that a company operates in market with extremely low interest rates, so you could approximate the interest rate to be zero. So there is no point of even talking about interest expense. So that's again just for simplicity. Now taxes and net income would be kind of proportionate to sales, but again, if your taxes and net income are driven by depreciation and interest expense to a certain degree, then of course your taxes and net income will not be directly proportional to sales. But if we assume that depreciation and interest expense are indeed directly related to sales, then of course it follows that taxes and net income would be directly proportional as well. So, bottom line, for now, assume that all items on income statement are directly proportional to sales. Okay, so we are making that strong assumption, but again, I do want you to understand that depreciation and interest expense are not necessarily going to be directly proportional. Okay, all right. How about balance sheet? Well, let's think about balance sheet. So balance sheet is your, let me just write that down here. You're going to have your current assets, you're going to have your fixed assets, and your liabilities will be current liabilities, long-term debt, and then you're going to have equity that would include common stock, retained earnings, and that's it for now. So let's assume there is no preferred stock. Let's not confuse ourselves here. So let's think a little bit. So what part of the balance sheet is going to be directly proportional to sales? Okay, is it reasonable to assume that current assets are going to be proportional to sales? And the answer is absolutely yes, because current assets are directly related to sales. You're talking about inventories, accounts receivable, and cash holdings for transaction purposes. So definitely related to sales. No doubt about it. Fixed assets, it depends, but it's reasonable to assume that they will also be related to sales. Let's assume that the company already operates at full capacity. So in order for it to increase its sales, it needs more capacity. So if I'm Tesla, I'm already operating at full capacity. My California plant operates at full capacity. If I want to expand in China, I will need to build new plant. So from that perspective, you could assume that fixed assets are related to sales. You could make another argument and say, what if the firm is not operating at full capacity? Well, then it's a different story. I may be able to accommodate a relatively small increase in sales without expanding my capacity. So let's say my plant is operating at 90% capacity. If I expect to increase my sales by 10%, I could still use my old plant and equipment. So there is no need for me to actually change my fixed assets. So depending on your assumptions about capacity utilization, you could assume that fixed assets either are directly proportional to sales or maybe they are not. So that could be easily modified, but you need to be aware of the situation of the company. So what we will do, we will assume for now that all assets, that's basically what we're going to do, all assets, including fixed assets vary directly with sales. So very directly is the same as to say that they're absolutely proportional. Now let's turn to liability side. Well, on the liability side, things are a lot different. You cannot really assume that your liabilities will automatically rise with your sales because those are negotiable things. You need to raise that funding. So normally, only some part of liabilities is directly proportional to sales, and that part usually is called accounts payable. Okay? So accounts payable normally are directly proportional to sales, and I mentioned that before. It means that your supplier is always willing to credit you. Anytime you increase your sales, they are willing to give you more raw materials because they understand that you will use those raw materials to make more sales and as a result generate more profits and as a result give more business to the supplier. Okay? So that would be here. That would be part of current liabilities. So I would say accounts payable. And then you have notes payable. So what I'm going to do, I'm going to put check mark here for accounts payable, meaning that they do indeed vary with sales, and that's why we call them automatic liabilities. But notes payable, long-term debt have nothing to do with sales. You will need to negotiate those things. Okay? And finally, your equity, only retained earnings will be directly proportional to sales because retained earnings are coming from your income. And if you assume that your income is going to be growing with your sales, which is a very reasonable assumption, your retained earnings, your addition to retained earnings, will also be proportional to your sales. Common stock has nothing to do with your sales. Common stock, again, needs to be negotiated. If you want to issue new shares, you really need to do it. You need to negotiate. You need to do it in advance. You can't just assume that anytime you increase your sales by 10%, your common stock will rise by 10%. That's nonsense. In fact, throughout this analysis here, we will assume that the company does not want to issue any new share. So that's a very important assumption. So assumption, no new shares. Very important. Okay, so from now on, we will assume that you want to operate without any new equity coming from new shares. Your equity will still rise, but it will rise only due to retained earnings. You don't want to issue new shares because you don't want to dilute the ownership of your current stockholders. Most companies just don't want to do that. Okay? So, once you apply that percentage of sales approach to your income statement, to your balance sheet, you will be able to do this stuff here. Okay? Your delta assets, your delta retained earnings, your delta automatic liabilities, and the difference is going to be your EFN. So basically what I wrote here in the formula, you will just put it in tables. You will just put it in your projected income statement, projected balance sheet, and you will see all those numbers. Okay? So that's the goal. That's the goal of the percentage of sales approach, to figure out that EFN, which turns out to be the difference between the forecasted increase in assets and the forecast increase in liabilities and equity. So let's now work with some data here. So let's say you have a company, it's called Rosengarten Corporation. The example is coming from your textbook. So let's say you have current sales, cost, taxable income. So as you can see, there is no depreciation here for simplicity. There is no interest. So there is no worry about what really varies with sales. In fact, everything on income statement is going to be proportional to sales. So what we do here, once we observe current sales, different cost, incomes, we convert everything in percentage of sales. Okay? So for instance, cost of goods sold, 80% of sales. net income is 13.2% of sales, and so on. Once we do that, let's imagine that you project 25% sales growth. So projected growth in sales is equal to 25%, which means that your projected sales are equal to 1,250, okay? Or, in other words, your delta sales is equal to 250. So there are different ways to look at it, but for now, we just want to know that projected sales. So that's the number you got right here. So you project your sales are going to rise to 1,250. Now what you're going to do, you're going to take each proportion here from your old income statement and apply it to this number, okay? So it's still going to be 80% of sales, but now you apply it to the new sales number. So 80% out of 1,250 will give you 1,000, and so on. So you repeat that exercise, you apply the same proportions, but to the new sales number. And again, that makes sense. You just make an assumption that, as long as you know your sales, everything else is directly proportional. So what's the purpose of this exercise here? The purpose is to figure out this number right here, addition to retained earnings. Because remember the goal. The goal is to figure out your profitability, your income, and then once you know what part of your income is retained, in our case it's 66.7% of your total income. That's your so-called retention ratio. So let me specify that. So that's your retention ratio. And this, by the way, 33, that's your dividend ratio. Of course, together, dividend ratio plus retention ratio has to be equal to 1. Okay? So, but remember what it is. It's dividends divided by net income, or retained earnings divided by net income. So, once you forecast your net income, that is equal to 165, and once you know that 66.7% of that income is going to be your retained earnings, you will come up with addition to retained earnings equal to 110. So let me now go back to my example here. So my EFN, let me just rewrite it, is equal to delta assets minus delta so-called automatic liabilities minus delta retained earnings. So my EFN is equal to, and now I'm going to fill in the spots. Basically, I'm going to find the numbers for each of those components. So what I found so far is that $110 will come from retained earnings. Okay, so that's what I achieved right here when I calculated my projected income statement. The next step is to figure out what's going to happen with the balance sheet. Okay, so here's my current balance sheet. So we will assume that all of your assets are directly proportional to sales. That's why we apply these proportions here, okay, to all parts of your assets, okay. And the total assets are equal to $3,000, and that is 300% of your sales. And that makes sense. If your sales are 1,000, so let me just write that down here, just to remind you. If your sales are 1,000, then your total assets are 3 times as much, which is 300%. Then we turn to liabilities, and here there is only one percentage that is listed for accounts payable, nothing else. And the reason for it is because that's the only liability that is automatic. That's the only liability that we can reasonably believe that will be provided by your supplier, no questions asked. We cannot apply any proportions to notes payable or long-term debt or common stocks because we don't know what's going to happen to those items. Actually, we do know that common stock is not going to change because we don't want it to change. But in terms of long-term debt or notes payable, it will depend on market conditions. It will depend on our ability to negotiate that borrowing, and it would also depend on relative cost. So we can never assume that those items will be directly proportional, no questions asked. So our first goal is to figure out what happens if we simply finance our future assets with automatic liabilities like accounts payable and retained earnings. Then we're going to see how much gap we're going to have and what we're going to do about that gap. So that's exactly what the next slide does. That's your pro forma balance sheet that is based on sales equal to 1,250. So what we do here, we now apply the proportions from this slide to the new sales number. So for instance, how did we come up with total assets projected equal to 3,750? Well, that is basically 3 times 1,250. How did I get 3? Well, our total assets are 300% of sales. So I just applied that number to the new sales number, and there we go. I got my total projected assets equal to 3,750. So what does it also mean? It also means that my delta assets are projected to be equal to $750, right? So my assets used to be 3,000. Now they are 3,750. So the difference is 750. So coming back to my calculations here, my delta assets is going to be 750. Okay, so what do we know so far? We know that my projected assets are going to go up by 750. 110 will be covered by retained earnings. So that's exactly what I have here. My retained earnings went up by 110, so my delta retained earnings is equal to 110. And finally, let's look at what happens with my accounts payable, because that's another item that automatically comes into my firm, no questions asked. So as you can see, my accounts payable are now 375. How did I get that number? Well, I took the proportion that I have, 30%, and I multiply by the new sales number. So it will be equal to 0.3 times 1,250. And that will give me 375. So my accounts payable increased from 300 to 375. So my delta accounts payable is equal to $75. So now I can go back and put 75 right here. That's it. I'm set. Now, whether I'm doing it here using formula or I do it here looking at my balance sheet, the bottom line is that my total projected new assets are going to be 3,750. My total projected liabilities and equity are going to be 3,185. There is a mismatch. It means that your projected pro forma balance sheet does not balance. You have $565 deficit, EFN. And that is exactly what you need to worry about. So here, if you calculate, excuse me, 750 minus 75 minus 110, you're going to get 565. So again, it doesn't really matter if you do it using formula or using the table. The bottom line is that you have $565 deficit. Okay, do we stop here? No, we just uncovered a problem. Okay, we want to grow very aggressively. We expect our sales growth to be 25%, which is a lot. So it's not surprising that we will be short. We will not be able to continue our operations. We will not be able to achieve that growth without any significant additional funding. That's why we calculated this number. That's why it's so crucial. Because now we know that we need additional $565. The question is, how are we going to raise that money? And that's what you have on this slide. So now, as I mentioned before, this part of how you're going to cover that external financing need, this is something that we're not going to go into in this course. We will just randomly choose one of the options without explaining why, because that's a completely different topic. Okay? So what happens here in this example, as you can see, we used notes payable and long-term debt. Okay? So as you can see, your notes payable increased by 225 and my long-term debt increased by 340. Together, that's exactly 565. Why is it done that way as opposed to raising all of the money through long-term debt or all of the money through short-term debt, which is notes payable? Well, that's not clear. That's just random assumption. It depends on the managerial preferences. So it's up to the management to decide how to cover that external financing need, how to cover that deficit. But you need to do that. You need to somehow use those plug variables to kind of plug the hole, to plug the deficit that is associated with your asset and sales growth. Okay? So before we get to the shortcut formula, let me just summarize what's going on. Again, you expect your sales to grow. Usually, sales growth is associated with asset growth. Asset growth requires financing. Some of your financing comes straight from your supplier automatically in the form of accounts payable. Some of your financing is coming from profits that you're going to generate. So that would be your retained earnings. Unfortunately, in many cases, your increase in assets exceeds your automatic sources of funds, like accounts payable and retained earnings. So what's going to happen? You might need to raise additional borrowed money. That would be your external financing need. So we need to forecast it. Once you forecasted your external financing need, you need to think about how exactly you're going to do it. Short-term debt versus long-term debt, some kind of combination of the two. But you normally assume that you do not want to issue new equity. You don't want to issue new shares. The assumption is that shares are untouchable. You simply want to grow through retained earnings and borrowed money, no new shares. Okay, so that kind of summarizes where we are for now. Now, turns out that we can take a shortcut and calculate EFN relatively easily and quickly without any tables. Basically, the first part here is your delta assets. So let's try to understand why it's the case. Well, think about it this way. If we assume that proportion of assets to sales is constant, right? All we need to know is by how much your sales are going to increase. For example, in our case, assets relative to sales are equal to 3. So what does it mean? It means that for every dollar is in sales, we need $3 of assets. So if we need $250 in sales, that means we will need $750 in assets. So it's 3 times delta sales. Same logic here. That's going to be your delta I call it spontaneous, but I like automatic better. Automatic liabilities. Remember, automatic, spontaneous, same thing. So if I know that for every dollar of sales, I will get automatically 30 cents from my supplier, then for $250 of sales, I would need 0.3 times 250 from my supplier. So again, that's how we do it. Finally, your last formula shows you delta retained earnings. Now that one is a little bit different from the other two. So let's kind of break it down logically. So the first part, profit margin times projected sales, that is your projected income. Think about it this way. What is my profit margin? Profit margin is equal to net income divided by sales. So now what's going to happen? That means that my net income would be equal to my constant profit margin times my sales. So basically, my projected net income is equal to my constant profit margin, which again is an assumption. We assume that, profit margin is constant. So net income relative to sale is stable, times projected sales. Okay? And again, that makes sense logically. So if you know that your profit margin is 13% here, and you also know that your projected sales are going to be 1,250, you will immediately know what your projected income is going to be. You will just multiply that profit margin times your projected sales. Okay? So this part here is your projected income. But that's not the end of the story. Regardless of how big your projected income is, if you do not retain anything in the firm, you will not be able to generate any retained earnings. That's why you always need to multiply by 1 minus D. 1 minus D is 1 minus dividend payout ratio. So let me just make it clear. So D is dividend payout ratio, but B is retention ratio. B is equal to 1 minus D. Okay? So that's why we have 1 minus D here. You could think of it as B, or retention ratio. And that, again, that makes sense. If 20% of my income is dividends, then 1 minus 20%, which is 80%, would be my retained earnings. If 80% is my dividends, then only 20% are going to be my retained earnings. So we could have had profit margin times projected sales times B, but the general convention is to express it in terms of D. And the reason for it is because D is dividend payout ratio. That's a policy variable. It's a managerial policy variable. And therefore, we like this formula to be expressed in terms of D.